Tom Lee says there's more fuel in the tank. Do you agree?
Well, I think what we have to be cognizant of is that the flow backdrop for equities has been pretty solid all year, characterized by very, very strong flow action into broad-based U.S.-listed ETFs and mitigated by lesser outflows in the traditional mutual funds. So the flow backdrop continues to, in our view, kind of support the action we've seen into the broader S&P 500 and broader market complex.
How do we deal with the issue of what's priced in terms of a tighter Fed? Is it in the market yet, or are we just enjoying? Are we just enjoying a period of time here, and then reality is going to set in shortly after the beginning of the year?
It's a really good point. So, we're using an end of 22 target of 4,900. When we set it a couple of months ago, that gave us mid to upper single digit upside. That's not the case where we are currently. I think the way we have to think about this is as you push higher into the end of the year, you see valuations lift. The S&P is trading at about 24 times right now, and that's predicated on no real change in our 22 earnings growth outlook, which is around 8% or so. So essentially, what you do is the further you push the market higher into the end of the year, the more pressure you put on earnings and the need to come through with probably stronger than expected earnings as we move into Q4 reporting and then into the 22 outlooks.
Scott, a lot of people watching, as we've talked about the last couple of days, sort of the narrowing leadership and some of the internals. For example, number of new lows earlier in the week, double the number of new highs on the NYSE, with the S&P at a 52-week high. It's only happened a few times, all of them in December of '99. So as people look for analogs to that period, are they trying to, is it too glib, or are there real similarities to that period here?
I think there's a little bit of know your index here and how it relates to what's traded on the NYSE. So if you look at the S&P 500, for example, work we did last week suggested that your average stock is off, let's say, 11% or so from 52-week highs. This is very typical. It's very consistent with the historic pattern. And that breadth issue under the surface often tracks with volatility pretty closely. The other thing I would say here is that when you look at the S&P 500, back of the envelope math is your top 10 weights are probably 30% of the total index, and those have contributed about 40% of the index gains. Said differently, the S&P 500 equal weighted index is trading up this year roughly on par with the core index. So that issue under the surface is less about the S&P 500 and more about in the smaller and mid-cap asset classes.
Shepard Smith here. Thanks for watching CNBC on YouTube.